Right now, inside your retirement account, something is happening that nobody told you about. It is not a scam. It is not illegal. It is just a number. A very small number. Written in very small text. That is quietly, methodically, compounding against your retirement every single day. Let me show you the math. Because once you see this, you will never look at your 401k the same way again. Imagine you have $150,000 in your 401k right now. You contribute $500 a month for the next 30 years. The market averages its historical 7% return. In the right funds, low-cost index funds, you retire with approximately $1,730,000. In the average actively managed mutual fund in the average 401k, where the expense ratio is 1.1%, you retire with $1,230,000. That is a $500,000 difference. For the exact same investments. The exact same market returns. The exact same contributions. Just the fee. So what exactly is this fee? It's called an expense ratio. And I want to explain this in the simplest terms possible because the financial industry has an interest in keeping this confusing. When you invest in a mutual fund or ETF inside your 401k, that fund charges you a fee every year to manage it. That fee is the expense ratio. It is expressed as a percentage of however much money you have in the fund. At 1%, if you have $100,000 in a fund, you pay $1,000 per year. If you have $500,000 in that fund, you pay $5,000 per year. But here is the part that compounds the damage. You don't just lose the fee. You lose every dollar that fee would have earned for you over the next 30 years. At 7% growth, $1,000 today is $7,612 in 30 years. Which means a 1% expense ratio doesn't just cost you 1%. It costs you more like 25 to 40% of your final balance, depending on your timeline. Here is exactly how to find what you're paying right now. This takes 4 minutes. Step 1. Log into your 401k plan. Your HR department set this up. Check your original benefits paperwork for the website. Step 2. Navigate to your current investments. Usually labeled My Portfolio, My Investments, or Account Details. Step 3. Look for a column called Expense Ratio or Annual Fee or just Fee. It might be written as a decimal 0.85% or in words 85 basis points. Write down everything you own and its expense ratio. Then compare to what the same exposure costs in a low-cost version. Here are the benchmarks you should know. If you see these numbers in your plan, these are the warning signs. Any expense ratio above 0.5%, paying too much. Move if there's a cheaper equivalent. Above 1%, paying way too much. This is actively costing you hundreds of thousands of dollars. Above 1.5%, your employer either doesn't care or doesn't know. You need to fix this immediately. What should you be targeting? For a U.S. stock market index fund, 0.03 to 0.05%. Vanguard's VTSAX charges 0.04%. Fidelity's Zero funds charge 0%. For a bond index fund, 0.05 to 0.10%. For an international index fund, 0.05 to 0.12%. Now, here is the problem a lot of people run into. Not all 401k plans are created equal. Some employers, particularly small businesses, offer plans with limited fund options, and sometimes every option has high fees. If that's your situation, you have 3 moves. Move 1. Look for the target date fund with the lowest expense ratio. Even if it's not perfect, it might be your best available option. Move 2. Contribute only up to your employer match in the 401k, not a dollar more. Then put everything else into a Roth IRA, which you control, and where you can buy any low-cost fund you want. Move 3. Talk to HR. This sounds uncomfortable, but it works. If even a handful of employees ask why the plan has high fee funds, employers will often switch. They have a fiduciary duty to offer reasonable options, and many just don't realize how bad their current plan is. There is actually a federal law, the Employee Retirement Income Security Act, ERISA, that requires employers to offer a plan that is in employees' best interests. High-fee funds arguably violate that. Employees have successfully sued employers over this. Mention that, calmly, to your HR department. There is a second type of fee that almost nobody knows to look for. It is called a plan administration fee. And unlike expense ratios, which come out of your fund holdings automatically, this one often shows up as a separate charge on your statement. Some plans charge $25 to $75 per quarter, per account holder. That is $100 to $300 per year, just for the privilege of having a 401k with that particular provider. Most people never notice this. It just appears as a small deduction. But $200 per year over 30 years at 7% growth is $18,895 you never see. Check your statements. Look for any fees that aren't labeled as investment related. If you find them, you now know why they exist, and you can factor that into your decision about where to put money beyond the employer match. Here is your 3-step action plan. I want you to do this within 72 hours. Step 1, log in and audit. Find every fund you own. Write down the expense ratios. Total your annual fee cost. That number might shock you into action. Step 2, look for alternatives. In your plan, search for funds with index in the name. Or look for Vanguard, Fidelity, or Schwab branded funds, these tend to be lowest cost. If you find an S&P 500 index fund charging under 0.1%, that is probably where your US equity money should be. Step 3, make the switch. Log into your account. Find change investments or rebalance portfolio. Move your current balance and your future contributions to the lower cost alternatives. This takes about 20 minutes. And it could add $300,000 to $500,000 to your retirement. Here is the thing about the financial industry. It is not evil. It is just optimizing for its own interests, which is what every business does. The problem is that most Americans don't know enough to optimize for theirs. You now know what to look for. You know the number. You know the impact. You know the fix. The next step, if your 401k options are limited and you want to know exactly how to set up an IRA, is in the next video, right here. Because that is actually where most of the real wealth building flexibility lives. I'll see you there.